$47.32. That's the median savings account balance for American millennials. Not 4,000, not 400. $47 and some change. Now here's what should genuinely terrify you. By the end of this video, you'll understand exactly why that number is a financial death sentence, and I'm going to show you the math that proves it. But first, I need you to consider one question. What's your plan on a random Tuesday at 2 p.m. when your car dies on the highway and the mechanic says it'll be $3,000 to fix? Not next year. Not when you've had time to prepare. Tuesday. This Tuesday. Do you have it? Can you get it? What exactly happens next? Most people don't have an answer. And that's the problem. Because life doesn't schedule emergencies around your payday. Here's a stat that should keep you up at night. 57% of Americans can't cover a surprise $500 expense with cash. Over half the country, living one blown transmission away from financial catastrophe. And what do people do when that emergency hits? They reach for plastic. The average millennial carries over $5,000 in credit card debt. So that $3,000 car repair, by the time you pay 18% interest over 2 years, you didn't pay $3,000. You paid closer to $3,600. You essentially paid a 20% tax on being unprepared. But that's just the surface-level damage. The real cost is what economists call the cascade effect. And once you see it, you can't unsee it. Here's how the cascade works. Let's say you have no emergency fund. Your car breaks down. You put the repair on a credit card. Now your monthly expenses go up because you're paying interest, which means you can't save anything that month. Then your rent goes up by $100 because your landlord is renovating. Now you're even further behind. So you start cutting corners. Maybe you stop contributing to your retirement account. You've just stolen from your 65-year-old self to survive your 28-year-old present, or worse. You take out a payday loan. The average payday loan has an annual percentage rate of nearly 400%. You borrow $500, you pay back $2,000 over time. That's not a loan. That's a financial vampire. This is why financial advisors, the ones who actually know what they're talking about, call emergency funds the foundation. Not the roof, not the fancy kitchen, the foundation. Because everything else you build, your investments, your retirement accounts, your wealth plan, all of it sits on top of this one thing. Without it, you're building a house on sand, and the first storm that comes, the whole thing shifts. So how much do you actually need? This is where most people get it wrong. They hear financial gurus throw out numbers like 6 months of expenses, and they immediately check out. Because 6 months of expenses when your rent is $2,000 and your car payment is $400, that's $15,000. When you've got $47 in savings, $15,000 might as well be $15 million. So let me give you the real framework, the one that actually works for normal people. Stage 1, $1,000. That's it. Your first and only goal is to get $1,000 in a separate savings account that you pretend doesn't exist. Not an investment account, not tied to your checking, a literal separate bank if you have to. This is your wake-up fund. It's the money that turns a crisis into an inconvenience. Flat tire? Covered. Emergency room copay? Covered. Dog ate something stupid and needs the vet? Covered. You're not financially free, but you're not financially fragile anymore. And that difference? It changes everything about how you sleep at night. Stage 2. 1 month of essential expenses. Not your full lifestyle, just the must-pays. Rent, utilities, groceries, minimum debt payments, insurance. For most millennials, that's somewhere between $2,000 and $3,000 depending on your city. This gives you a real buffer. It means if you lose your job tomorrow, you have 30 days of runway before the panic sets in. 30 days to figure it out without making desperate decisions. Stage 3. 3 months of essential expenses. This is the target. This is where you cross the line from financially vulnerable to financially stable. 3 months means you can survive a job loss, a medical crisis, or a major home repair without going into debt, without raiding your retirement, without borrowing from family. 3 months is independence. and stage 4, 6 months or more. That's for freelancers, commission-based workers, people with unstable incomes, or anyone who just wants to sleep like a baby regardless of what the economy does. But that's later. Right now, we're talking about stage 1. Because you can't run before you walk. Now here's the question everyone asks. Where is this money supposed to come from? I'm already broke. And I get it. When you're living paycheck to paycheck, the idea of saving $1,000 feels like someone telling you to climb Everest when you can't even touch your toes. But here's the method that actually works for people who don't have extra money lying around. First, automate a tiny amount. I'm talking $25 a week. That's less than most people spend on coffee. Set up an automatic transfer to a separate savings account the day after you get paid. Not at the end of the month when you hopefully have money left over. Because you won't. The day after. Before you even see it. $25 a week is $1,300 a year. You'd hit stage 1 in 10 months without even thinking about it. And here's the secret. After about 3 weeks, you won't even notice it's gone. Your spending expands or contracts to match what's available. This is called Parkinson's Law applied to personal finance, and it's the single most powerful tool you have. Second, take every windfall you get and bank it. Tax refund, birthday money from grandma, stimulus check, side gig income, rebate from buying a phone. Any money that isn't part of your normal paycheck goes straight into the fund. The average tax refund is over $2,700. One refund could fully fund your stage 1 and most of your stage 2. Third, do a one-time audit of your subscriptions. The average millennial spends over $200 a month on subscriptions. Streaming services, gym memberships they use twice, app trials they forgot to cancel, that meal kit box that seemed like a good idea. Cancel the ones you haven't used in the last 30 days. Redirect that money to your emergency fund. You could free up $50 to $100 a month in 20 minutes of scrolling through your phone. Fourth, sell stuff. Eggs go through your closet, your garage, your storage unit that's costing you $100 a month to rent. Sell it. Put every dollar into the fund. Most people have $500 to $1,000 worth of stuff they never use just sitting around collecting dust. None of these are revolutionary. They're not sexy. They won't make you a millionaire. But they will make you financially bulletproof against the things that bankrupt most people. Now, let's address the elephants in the room. The arguments against emergency funds that you've probably heard or even told yourself. But my money should be invested, not sitting in savings earning nothing. This is the most common objection, and it sounds smart until you actually run the numbers. Let's say you put $5,000 in a high-yield savings account, earning 4.5%. That's about $225 a year in interest. Not great. Now let's say instead you invested that $5,000 and got 8%. That's $400 a year. The difference is $175. $175. That's the cost of your emergency fund. That's the insurance premium you pay to know that when life hits, you don't have to sell investments at a loss, pay capital gains taxes, or go into high-interest debt. Think about it this way. You don't cancel your car insurance because you haven't gotten into an accident. The return on insurance isn't the payout. It's the peace of mind. It's the optionality. An emergency fund is insurance for your entire financial life. Another objection. But I have credit cards. That's my emergency fund. No. A credit card is an emergency loan at 18 to 24% interest. That's borrowing your way into a worse emergency. Remember that cascade effect we talked about? This is step 1 of the cascade. You're choosing to walk directly into the trap. And the last one, I'll just ask my family for help if something happens. Maybe you can. And if you have that safety net, count yourself lucky. But relying on family creates relationship strain, guilt, and a dynamic where your financial instability becomes someone else's burden. Independence isn't just a financial goal. It's an emotional one. And the day you handle your first real emergency with your own money, without calling anyone, without asking permission, without the shame of admitting you weren't prepared, that's the day you actually feel like an adult. So let's land the plane. Emergency funds aren't a nice to have. They're not an intermediate step for people who are already good with money. They are day one. They are the prerequisite for every other financial decision you'll ever make. Investing without one is gambling. Budgeting without one is temporary. Building wealth without one is building on a fault line. The economy doesn't care about your feelings. Job losses don't warn you. Medical bills don't negotiate. Cars don't care that you just paid off your credit card. Life will test you. The only question is whether you'll be ready. Start with $1,000. Automate it, protect it. Don't touch it unless it's a genuine emergency. A sale at your favorite store is not an emergency. A last-minute trip to Vegas is not an emergency. A new phone when your current one works fine is not an emergency. This money has one job: to catch you when you fall. If this was the wake-up call you needed, there's more where this came from. The channel breaks down money stuff exactly like this. No fluff, no judgment, just the framework to get your financial life together.